Well, thanks very much for having us. This is joined with Tim at Texas and Monica, who's here to answer your questions. This is an empirical paper about housing volume. So starting point is California prices, which we suffer from. This is San Diego County, normalized to 1 in 98, big boom bust, and now times are expensive again. Or if you bought in 2008 like we did, then you're sort of over it. Okay? So this is it's a familiar picture. Many people have thought about this. And in particular, people have thought about the cross-section of different segments of the housing markets within a city or across cities as well. So the typical picture there is looks like this. This is quality defined by price range. And I'll do this in more detail later. This is, for now, just going from blue to pink. So the quality going up. So Trump Tower with its pink marble and stuff, that's the most luxurious. Okay, and that had the lowest growth rate and sort of the most shallow decline, whereas the relatively lower quality segments, they had a lot of the action. Now, this is something that's well known, and many people have thought about it. And the typical stories that one grapples with, that the literature has made a lot of progress on, I think, is that it thinks about the differences across borrowers, right? Or difference across buyers in particular. Things like. So this is, when I say quality, it'll be defined by price tier, so it doesn't explicitly distinguish. So location does play an important role. So I don't have a sort of a crisp difference, but things cluster, right? I mean, also as stuff gets developed, you've got these new developments that have larger lots and bigger houses, so it's kind of hard to do a precise decomposition. What I can say is that, and that's going to be important, is if I define the price just based on narrow location, as opposed to price at the individual property level using a repeat sales index, I get very similar results for these tiers. Okay, so in that sense, location is kind of a way to summarize well what's going on. Okay, so the typical study looks at buyers and says stuff like, okay, we got to understand why people bought. Why did they have these expectations that they were able to buy here? How did maybe credit was so cheap that they bought here more and these types of things. And in what we're going to want to think about here is the other side. This is how does so who sells? Okay? And so the first thing to look at there is look at volume. This is annual volume in San Diego, and you see that there is a lot of action there as well. And we'll go into more detail. And we can then also split that by segment. And then there is a lot of heterogeneity and action to think about also. And so that looks a bit messy for now, but I hope that that's what the talk wants to do, is to clean up the mess and sort of structure that for you and give you an overview of how did volume look like by segment over this period. Okay? That's the game plan. So the question is, who sells? We're going to study volume by segment over the boom-bust cycle and this recovery, this new boom. And the punchline is going to be, there are significant differences in the sell side across segments. Now, does that matter? Should we care about this? We'll have to see. I mean, the strawman model that you might want to have in mind here is sort of a sad one. Let's say that always just a couple of like a fraction of people die every year, and then and those houses come on the market, and then they got to be sold, and then all the action in terms of the price comes from the behavior of the buyers. Right? So that'd be kind of one way that would be a setting in which what happens on the sell side doesn't really matter. Now, I think, and we sort of have a lot of ingredients in the literature on how buyers differ. And in a general equilibrium setup, what happens on the sell side, what's different there is also present. And so the question is there systematic differences across these segments that differ so much in price. That's what we're trying to find out. And so we'll give you a list of facts, and then you'll be able to form an opinion. We're not going to have a definite conclusion here. Very good. So how we're going to do this? We're going to take data on the San Diego housing transactions. We're going to, yeah. Yeah, well, that'll be one. That will be one interesting issue to look at. Also, you'll get information there. Yeah. So we'll take data on these transactions, and we'll slice them by market segment, and we'll slice them by types of owners and types of seller, such as developer, for example. And then we're going to ask document answers by segment to various questions. So first, we're going to ask how are houses transferred. And that's particularly important because we had a lot of foreclosures in California. So we're going to look at that. Then we're going to ask, so who sells? And because housing is an over-the-counter market, we can also ask who sells to whom. Every transaction is a pair. So we look through. And then how quickly do people sell? That is, what's sort of the duration? How did that change? And then we're going to go in more detail at the supply. So if we were just doing kind of modeling stock market with heterogeneous agents, it'd just be about this. With housing, then you also wonder, so how does the house get used? Okay, so I want to talk about owning versus renting, and what stands around vacant. And then finally, we'll take a look at financing from the perspective of people who already have a house and are thinking of selling. So that's the plan. Okay, so the data is, as I was saying, this is from San Diego County. We like San Diego. It's not that we will only write papers on these in the future, but so we like it because it's this kind of self-contained area, right? So you have like Mexico and the Pacific, and then there's a desert, and then there's a military base. And so you have this enclosed area, which is about 100 million households. And it's one county, one MSA. So it's sort of a commutable area where you think about, if people think about where to move, then they're moving within here. Okay, it's sort of far to Orange County in a way, so that it in many ways that sort of qualitatively is very similar to the typical West Coast market over this period. That it had this large boom bust cycle and then a significant recovery, and we're going to study this using two sources of data. One is just deeds records that's got information on location and price and seller and buyer mortgage info. And then that's about 800,000 transactions over this period, 1998 to 2014. And then we'll have two decennial censuses as well as the ACS, which we're going to use to look at some more details of the housing stock. And the match between these things is going to be by census tract. So let me talk about how we do the cross-section of houses. There are going to be 6 quality segments. Those were the ones that were already in the figure before. And the way that gets defined is we're going to take the tract in 2000 and look at its median price, and then split the housing stock equally by that statistic. Okay? So we're going to have 6 segments of equal size in terms of 2000 housing stock that are sorted by median tract price. So it's a location measure, and it's the median tract price is what matters. Why do we do it like this? It's as I was saying, this is something that picks up systematic differences in quality that you could also get with more disaggregated approaches, like using repeat sales approach at the property level. But what we can do if we have a location, fine location, is we can easily do average quantities at every year, say, without having to do a transformation of quality across. Yeah, that's it. That's the point. And so what does it look like? We can look at these prices.
These are all single-family homes?
No, it's everything. Yeah, it's a condos. Yeah, okay. Yeah. We did a split by condo. Is not a super large difference. There's some. Yeah. So we can talk about it more. Okay, so this is what these segments look like. So this is just level prices, so you get an idea for what people pay. This is so again, quality goes from blue to pink. There was a boom bust in all of these. There is a steep recovery in all of these that's been continuing. And then what is less visible here, but was visible in the previous picture, is that the percentage increase in the lower quality segments was much larger in the boom, and the drop much steeper here than for the luxury segments. And so that is a typical picture of tired price indices, however defined in coastal US. And what's interesting is that if you just look at the recovery, say, from 2010 to now, the same fact emerges again, is that you have again this boom. Everything's getting expensive, and the price appreciation is stronger in the lowest quality segments. Yeah.
So there's a stylized-ish fact that people are starting to come out with, which is that in the highest quality tiers, there may not have been much of a price decline at all. Now in San Diego, you were showing a 20% decline, roughly, in the top tier.
Yeah.
Do you have a sense for, is 20 the number you'd assign to San Francisco too? But I've heard anywhere from 0 to 10, you know, but there was basically no bust in the top.
So in Palo Alto, there was a 20% decline. I know this very well. And I'm happy we're over that. But so yes, I would say that this is pretty similar across coastal California.
Okay. And we know the number of transactions declined a lot, but were there still transactions in that top tier that you're confident in the 20?
Yeah, we'll see that. Yeah.
Okay.
Yeah, okay, I should say also, this is all actual sales, not foreclosures. Okay, REO sales are in it, but it's like, these are all prices of transactions where people pay for the house. And there's enough of those too. Okay, so let me see. So, yeah, now, so we're gonna have a bunch of facts that are gonna provide answers to these questions that was listed before. And the results are basically monotonic across the different segments. So like this price fact. So the price fact says the boom bust was more violent for low quality, and then it became sort of more and more violent, less and less violent, sorry. And then it was kind of most shallow for the top segment. And similarly, you can kind of have, as you go from low quality, high quality, things are sort of monotonally changing. We will need to come up with a way to properly summarize these. What we're going to do in this talk is just going to show you the results for the top and the bottom segment. And that's going to give you the basic facts. But then, you know, it sort of morphs through the intermediate segments also, the logic. Also, there's a lot of seasonality. We're going to take the plumber's approach to this. It's just going to show annual statistics. Okay? That's going to summarize the main things. One can do more fancy things later. Okay, so here's a look at volume and this question of how are houses transferred. Okay, so and so this is the typical structure of the picture that we're going to have. Bottom segment on the left, top segment on the right, and then here the mountain is, or the mountain range rather, is volume, total volume. And then the colors indicate different types of sales. These are new home sales. And so you see that there's a typical thing that developers like to build more in expensive areas. Because we have the segments of the same housing stock, at least as of 2000, you can sort of think of this as turnover rates as well, because it's the same denominator. Okay, so there's the fact that this mountain is larger than this mountain also says that turnover typically is larger in the top segments. And now then what's this, so then we have this blue, that's kind of just regular sales. A sells to B. And then the warm colors are about the foreclosure process. And so here it's useful to think of the typical foreclosure as two transactions. First, it goes from the foreclosed guy to the bank, and then the bank sells it back to a new guy. And so that's, we call the first one foreclosure and the second one REO sale. And then you see that there's a lot of this, in particular in the bottom segment. Here there's so much of this that you're getting this, it's really a mountain range with a valley. Okay, so there's this extra action in the boom. And then there is even larger overall amount of transfers of houses in the bust. Part of this comes because the transfer process is now more complicated, in that if for the house to go from Mr. A to Mr. B, there's the bank in between. Okay, so that's this piece. But even if we ignore this, so if we sort of split this in half, roughly, by leaving out the actual foreclosure, there is it's this bimodal thing. Okay. So action first and then later. Whereas in the top segment, there is just a decline. Okay. And, but there is a lot of action. And that is also, so both here and here coming back. Okay, so that's the basic pattern. So there's significant differences here in how things get transferred, even though a lot of stuff gets transferred in both segments. Another thing I want to point out is that, so two things. One is that the two warm colors, so the first step, things going to the bank, and then the second one, things going away from the bank, those are sort of similar in magnitude. And that suggests that it's not the case that the house goes to the bank and then a large share of the housing stock sits around and the rats go in and whatnot and so forth, but rather then it gets turned over and somebody else buys it. Okay? So it's just a transfer of houses, much like it was here. And we'll see this in more detail. The second thing is that if you think about the width of the REO sale and foreclosure regions over time is kind of large here, 2008 and 9, and then it narrows. Whereas here, I mean, it's overall small, but the size relative to the first one is similar. Okay, so the bottom segment is one in which a lot of people got in trouble right away in a crisis, and then the houses got processed, and that was that. Here, it's more drawn out, even though it's at a smaller scale. Okay? So in terms of if you sort of compare to the banking logic, there's these kind of zombie households that just that stay around and struggle, and then eventually comes the foreclosure. Okay? So the share of guys that get foreclosed late is bigger here. And that's also true in the intermediate segments that have relatively more foreclosures. So in this bottom segment, you get a lot of foreclosures, but most of them happen quickly, whereas here is more drawn out. Okay, so that was a first look at how to get houses transferred by segment. All I needed for that was a definition of a segment. So now I want to talk about who's doing this. So this is going to be about dividing people, not just dividing houses. So how do we do this? Well, take the deeds and then look at the buyer and seller names. So there's persons there, and we could just match names and thereby construct a portfolio history of each person over time. One might think that there's a lot of John Smiths, or in the case of San Diego, Juan Sanchez's, that then show up as people owning lots of houses, but that's actually not the case. That's partly because San Diego also is not such a big place, and people like to distinguish themselves. So this actually works pretty well. So we're quite confident that we have a sensible portfolio history, that we can assign unique ID numbers to people based on their reported name. And once we have that, then we're going to divide these persons into two classes. The first one is what we call simple movers. These are guys like me and probably you, who basically move from house to house. And the only reason why they might hold two houses at one point is because in the transition, that's kind of what you do. But you never have three houses, and you never have two houses for long periods. So that's the and then everybody else is going to be labeled investor. So that's going to have guys who have three houses, and then a bunch of guys who have lots of houses. So that's the split of persons. Also in the deeds data, there's firms, and these we're going to split into developers and everybody else, where developers is based on the name. Then, so everybody else we're going to label here foreclosure mill. That's a bit derogatory, and it's perhaps surprising that we label it this, but it turns out that to first order, everybody other than developers is basically involved in actually foreclosing on people to a significant extent. So this includes not only banks, so there's a bunch of banks in this, there are also funds or asset management companies, but the asset management companies that show up here are typically ones that do a lot of the foreclosing themselves. So for example, they might buy the rights to do foreclosures on a bunch of securitized mortgage bonds, etc. So that's why there is only one category. We have not found a good way or a reason to distinguish. Okay, so you can think of developers and then other guys, and that's typically bureaucracy that does this transfer of foreclosed houses. Okay, so now we have these groups, and we can look at how much everybody does. So this picture has, again, bottom segment, top segment, and it's got the buying and the selling by type. The buying are the positive numbers, the selling are the negative numbers. And both at the top and then mirror image on the bottom, there is the mountain range, that is the total volume, and it is now split into the 4 investor types with 2 additional colorings for foreclosures. So the green, the big chunk, that is the share of buying or selling by the simple movers. And then part of the transfer away from the simple movers that shows up for the negative numbers, that is the foreclosure. So that's what we call simple foreclosure. Okay? So that's part of the green in terms of type, but it's a different type of transfer. So that's a lot. Then we have the brown, that is the investors. And so that they do buying and selling, and then a bunch of them get foreclosed also on their houses. Then we have the developers. So the firms are these reddish things. The developers here, typically in the boom, and then you see these foreclosure mills taking over in the bust. In particular, in the bottom segment, where they're doing a lot of intake. So people transfer their house to the foreclosure mill. Sorry, I got that wrong. This is what jet lag does to you. So this is from the perspective of the type who's trading. So if the foreclosure mill takes in something as a foreclosure is this, and then it sells it again in an REO sale. Sorry. Okay, so it makes sense what we're looking at. All right. Okay, so now the technicalities are there. So let's think about how do things compare. So you see first that the basic patterns in the mountain ranges are mimicked by what these simple movers do. And this is a part of an important message, is that so these simple movers, just you and I transferring single houses. If we just looked at those by themselves, that's similar to the overall pattern. Okay, so the simple movers did a lot of stuff in the boom. Then there was this chill, then they got foreclosed, and then also they bought a lot of things out of REO. So they had this additional spike here. So in that sense, they mimic what the economy as a whole does. Then we have some investor activity. It's not overwhelmingly large, and it's not overwhelmingly different across the segments. Okay? So both in the low quality and the high quality segments, there is this churning by people who were investing. They get foreclosed quite a bit, also in particular in the bottom segment. And then you also see that their activity shrinks quite a bit. So there's a lot of gross buying, selling here, and much less here. And so this is a typical thing. If any type of, when we saw it with the migration before, but any type of asset trading, also foreign investors in stock markets and so on, is always that growth swamps net. So that's true here as well. And so then there is so this also sort of answered the question relative to the total churn, how much is this the role of these developers, which is much bigger in the top segment than the bottom. Okay, so that's what this says. Now, so because we're doing the buy and sell, so these gross numbers here, it's tricky to compare the relative sizes and zero in on the net. So this one I want to do next. And so now it's going to have a line that's just going to have, from the previous picture, the bottom minus the top minus the bottom for every type. And so this is so simple, investor, developer, and then rest or foreclosure guys. And so what is this? So this is clearest in the top segment. On net, what's basically happening is that new stuff gets bought, and mostly it's bought then, at least in its net sense, by the simple movers. Okay, that's the pattern. What about these investors? So we saw that in gross terms, there was a lot of churning by these investors relative to, in the boom relative to the bust. On net, what happens is they buy or enter in the boom, and then they go out in the bust. And they stay out. So there is this recovery that starts in 2010, and it turns out there is no increase in the net developer sales or buying activity by these investors in this second boom. And then this confirms what I was announcing before, based on just these gross pictures of the foreclosures, is that we have basically a flat line for these foreclosure bills, which means that on net, they don't absorb a lot of stuff and let it stand around for the rats to live in stuff. Okay, so that's the top segments. That's where there's patterns. Now, if you go to the other side, it's a bit more messy, but it's broadly similar, right? So you have, again, so the new houses, the construction was later, relatively speaking, in these low segments, and then on net, this was bought by these simple movers. You have some entry of investors in the boom and exit in the bust. Then here, this sort of absorption of stuff by foreclosure mills in 08, that was bigger. Okay, so there are some neighborhoods that stood around, but then also they sold off a bunch the next year, and so the overall absorption is not very big. So that's the net picture. So one key feature here is this investor behavior: is enter in the boom and then go out in the bust. So then one wonders, this could be for two reasons, right? Could be that is a composition effect. For example, there's always like old ladies that have lots of houses and some die, and then just new people come in, and it turns out in the bust less people come in. So then on net it falls, the investor. Right? Or is that people actively enter and then exit. So it's the same people trading. So what to distinguish these? And the way that we do that is we say plot the sales of the so the bias of the investors. That's this line. This is what we saw before as what the investors purchase. And then plot in addition for every year. So these are all the houses that investors bought in 2005. And then we ask, what are the houses that are ever resold during our sample, which stops in 2014. Okay? And so if this was 1, so the share was 1, this would mean that they're just churning. The same people are buying in a boom, selling in a bust. So it's individual. Okay? And that's close to true. So you see that, so this, the share of houses that get bought by investors and then resold again over this period, that is large. And that's again true for both of the segments. Is larger here than here, but so the conclusion from this is that there is in fact this entry of these investors, and then they just sell again. Okay, so let's summarize what we get out of looking at these trades by different types. So there was this boom-bust cycle. In the top segment, during this boom, there was a lot more activity by developers and net entry by investors. So this action characterized the top segment. And then in the bust, the developers stay away and the investors sell. So that it was strong. Now in the bottom segment, there was some of this, but less. Okay, so these two things here were not associated with the segment that had the bigger price action. The bottom segment was significantly different in that it had more foreclosures and REO sales. And then it's important that this was just a method of transfer. Foreclosures quickly turned in the REO sales. And in the bottom segment, they were front-loaded compared to the zombie action in the top segment. And the gross investor activity is relatively similar. Now, finally, what was also present in these pictures is that we had this rebound. And that happens basically without a lot of activity by developers and investors. Okay, so that makes you wonder about how important these elements are for generating booms. It turns out we can have this boom without them. Okay, so far we've looked at types and how they trade, and we haven't distinguished on who's on the other side. Okay, so in an over-the-counter market, we can do better. We can actually see who trades with whom, A to B. And why is this interesting? It's basically for how to think about these types of guys and what the houses are, whether there's further segmentation is needed. It could be, for example, that there is a market for apartments. It's basically all just a renter market, and it's sort of by itself over here. And then there is a market for single-family homes over here, where just these simple movers trade. But those things have nothing to do with each other. So we should write down models in which they're separate. Or it could be that there's a lot of cross-trading. Yeah. So this is what this is going to get at. So now it's again going to be a picture with purchases and sales. But now we're doing it by type. So the picture holds fixed the type. Okay? So in this case, it's the investors. So it's the question of who do the investors trade with? Who do they buy from? And who do they sell to or transfer the house to? And then again, it's color-coded in the usual way. Okay, so the first thing, and answer to the question that I said, is that there's a lot of trading between these investors and the simple movers. So this is really integrated. Okay, it's not the case that there's one market over here and over there, but there's all this interaction. And then, of course, I mean, there is also investor-to-investor trading, but it's small and similar to sort of the overall share of the investors in the total. So it's very much back and forth between the two types of investors.
So Martin,
yeah.
do you get information about how vacancy rates moved during those periods, and
Yeah.
whether those changed, and also whether the status of the property changed. It might have been an owner-occupied property, but then it became reconverted into a rental unit for an investor who was hoping to sell it, and he had to hold to the property longer. So do you have any information about how, property characteristics?
I'm going to show you some information from census that's going to get at that. Yeah, exactly. So that's exactly it's a natural question that one has from this, right? Is how does that relate to the usage of the house? So we'll get to that. It's not going to be as nice as this because it's not as high frequency.
But this data does not contain information about whether the property is owner-occupied versus tenant-occupied? Is that information contained?
There is information on the address. So we tried this. There's information on the address of the buyer, and you can compare to the address of the house. So we initially thought that might give a high-frequency way to do this. But that turns out, like if you, let's say you were to just sort into investors and simple movers by that, it doesn't really work well. And so we're sort of hesitant on using that. Yeah, but yeah, it'd be nice to have more high frequency stuff on that, but right now we don't. So I'll show you the limit, what I can say about that. Okay. Very good. So this is the investors. Now let me show you in comparison, this is for the simple movers. Again, purchases and sales by trading partner. And the message here is it kind of looks similar, right? It's again, so simple movers, they trade with each other and then they trade with investors. And their overall action mimics the total. So that's, the fact that the simple movers, how their situation changed over time, that is an important issue. Okay, so this was all about trades at a given point in time. We haven't connected them to look at holding spells. And so this is something that's interesting in order to think about what are the kind of shocks that make people move. Okay, so this is what we're going to do next. So it's clear from this that we need to understand how these simple movers, and to some extent also the investors, why this churning kind of changes over time. So it's really interesting to look at how long do people hold onto houses. Okay, so this is the first look at this. Again, the mountain is volume. And this is now split into when does it get resold again. Okay, so we have not good. Okay, sorry. So this is, so the total is all the volume. And this is anything that gets resold within 2 years, and this is anything that gets resold between 2 and 4 years. So that the total, not pink line here, area here, is everything that gets resold within 4 years. Okay, so this is not correct. Is it clear what I'm talking about? Yeah, so very quick turnaround, resold within 2 years, between 2 and 4 years, and then it's total volume. Okay, so message, this is a significant share, these short trades, and it's something that then really collapses. So there was a lot of quick churning here, and then it stopped, and it didn't come back. So then one possibility is this is basically driven by investors. So this is the big short thing. It's like all these weird people then investing in condos in Florida, whatever. They did that in the boom and then they stopped doing that. So that's true, partly. This is the duration of ownership, houses with less than 2 years for investors only. So that is initially large, then it drops. Part of it, so part of this stuff is foreclosed quickly here, more so in the bottom segment. And so this is kind of what you'd expect, is that there's a lot of flipping and churning and whatnot in the boom, and then it stops. Now let's look at this. So it makes sense what this says. So let's look at the simple movers. So this is just guys like you and I. And they have, this kind of dominant group of people that are doing most of the trades. And again, it singles out the trades with a duration of ownership less than 2 years. And distinguishes between those that lead to a sale and those that lead to a foreclosure. And the point here is that this is very similar to what we just saw for the investors. Okay, so in the boom, it was quite common, relatively speaking, for guys to move quickly. Guys who just move from house to house. And then they stopped. And so there was this kind of chill from the recession there. But then in the new boom, that didn't sort of resume. It's not interesting. So the last one is not interesting because then we don't have, so it only makes sense for 2012 because the data stopped in 2014. So you see some rebound, but it's not as big as it used to be. So there is somehow the dynamics of the market changed in the sense that these quick moves from house to house, those did not come back. And it is not just an issue of flipping by investors, but it's just guys moving quickly. Okay, so the second look at how different types trade, what we take away is first on the market structure is that there is this integration, that there is a lot of back and forth between the investors and the simple movers. And then that most trade is among simple movers, and that trade among simple movers exhibits all the features of the total. So this is really the thing that needs to be understood. And then in particular, for these short duration spells, you see this general kind of lots of them in the boom and then less in the bust. And it's also true for the simple movers. So again, so any story that talks about the opportunities to trade changed, it's got to apply to simple movers. It's not just about speculative activity or something like that. Okay, so we've discussed how the houses are transferred and who sells them and how quickly they sell. And now, so if this was a talk about the stock market, that'd be kind of what one would talk about. But because it's housing, it's a consumption good, it's not only an asset. Now it's interesting to think about what's done with the houses. Okay, so that is what Carlos was getting. So this is what I want to go to next. So here, okay, I got to prepare. So here I have less data because this is going to come from census. And so we're going to compare, we only have to work with the 2000 census, 2010 census, and then we have 2006 to 10 ACS averages. Okay, this is, we need this course because we wanted to have it at the segment level. So this is why we need to do these 5-year averages. And so we're just going to do two differences, basically. We're going to call them boom and bust. So it's roughly going to be the difference between the 2006 to 10 average and the 2000 census, and then 2010 census to the ACS. And it's going to give us broadly the pattern, broadly an idea of what's going on. Okay, and so it's going to be reported as follows. It's going to be, again, bottom segment, top segment. And then we're going to have, this is going to be the boom. So here we're doing difference between 2006 to 2010 ACS and 2000 census. And then what we're interested in is how do owner-occupied and rental places compare. So that's separate in terms of bars. And then the colors indicate types of houses. So gray, naturally, these are the old houses. And then the green, this is the fresh new houses. This means they've been built between the 2000 census and the 2006 to 10. And then we got the vacant ones. We're going to group them here with renters, but these are all vacant. Okay, so what's the pattern? Let's look first at this bottom segment. So notice that for the old ones, there's always possibly a positive and a negative one, because by looking in a disaggregated way by vintage, we can get an estimate of how much stuff was previously owned and is no longer. as well as what is new. So we get the gross changes in these owned houses and the rent houses as well. Okay? So so that gets us an estimate of conversion. And so then, so this is the pattern for the owner-occupied houses in the bottom segment. And so you see that a bunch of these old houses are no longer with us as owner-occupied houses here. But they basically get replaced by other old houses. And those must have come from somewhere. So they might have come from vacancies, or they might have come from rental. Okay? So there's this conversion. And so that means that the net inflow of old houses into this owner-occupied status is basically zero in this period. And then there was some construction. There wasn't a lot of new sales. We already saw that. There was some new construction. And then that generated some, as we'll see, compared to the other segment, relatively modest inflow. Okay. So there's evidence of conversion and some construction. Now, the other thing that's going on is that is here in the rental thing. The biggest action is that lots of old houses that used to be rental are no longer. And so we don't know exactly how it splits, but some of them presumably went here. They became converted. And then others must have gone to vacancy. Yeah. And then you can calculate sort of what are the ones that are retired. So there's some share that got replaced completely, because some of the new ones might be replacing them on the old lot. So you could have scrapping. That's more difficult to estimate by segment, because you need a total number of sort of permits that were issued. So I don't report that here. What I can say is that on aggregate, it is so one can sort of determine from total permits and the aggregate for these the total number of newly built houses that are vacant at the end of the boom, and that's close to zero. Okay? So that suggests that it's not the case that there was a lot of overbuilding and then the new stuff stands around. But instead, what happens is that the new stuff was sold, people moved in, and then there was old stuff that was still left and that was vacant. Okay? So that's the... Okay, so that's the pattern. So now, second, what's going on in this top segment? So we already saw that the new home sales were larger there. Now when we look at usage, you see that these green lines are big. Okay? So there was a lot of new stuff, both rental and owner-occupied. And so, I mean, if you've been to the meetings in San Diego lately, you kind of see why also this rental, right? I mean, all this harbor redevelopment, there's a lot of these towers there. And then, so in fact, there was this kind of rejuvenation, is that a bunch of these old houses got scrapped and then replaced by new. And in fact, there was even some conversion into rental in this top segment. And a lot of extra vacancies. So in terms of the comparison, what's the difference between the top and the bottom segment? Is that this is where the developers went to do stuff. This is so they did much less here. In fact, in this segment, overall, because you have all this big drop in rental and a small increase in owner-occupied, this is a segment that overall shrank in terms of the occupied units. So these kind of houses that became less people were there, whereas this is where the expansion occurred. Yeah. So okay, and so in terms of just the supply, so then one thinks about, okay, what does this mean for, how does this relate to price? So speculating, but one sort of reaction one might immediately have is that this is a segment where there was a lot of construction and the price didn't rise so much, and this is a segment where there was little construction and this kind of limited conversion, and the price rose a lot. So it's just a relative scarcity. But then what's interesting is that there's a lot of vacancy here. Yeah, so it's not so easy. So that's okay. So that's a pattern on the boom. Now let's talk about the bust. So we already saw that there wasn't a lot of new sales. And so, not surprisingly, then the green lines are basically tiny now. All the action is in the gray. And which way around does it go? Well, we need rental, right? So that's pretty clearly that this rental, old houses go up. And so there's a bunch of stuff coming from owner-occupied to rental being kind of converted back. Or well, I don't know back, but being converted. And that's also true here. So on this margin in the bust, there is significant action. So one would like to put this in perspective with the previous pictures. If you take, this is kind of a 3-year, so this should be interpreted as a 3-year difference. So it's about 2,000 units per year, whereas the typical volume is like 10,000. So it's a significant part of the action, okay, this reconversion. Okay, so let me summarize what we know about this construction conversion. So basically the boom saw that in the bottom segment there was some of this conversion, but overall very little housing and overall shrinkage. Whereas the top segment had this big expansion. That's where people wanted to be. So it's kind of people move out of the more crappy places into the nice places. That's kind of the big action. And then in the bust, basically in both segments you get this conversion to rental. In the bottom segment, that goes along with some of the previously created vacancies being filled, not so in the top segment. And I mentioned that there was little new construction that was vacant at the peak. So if we think about overbuilding, it's not about new stuff stands around, but rather is about old stuff that people have discarded. And then now you might wonder, because I mean people have made a big deal out of this push to the ownership society and reversal and so on. How does this look like? In general, this shift is not so big in California. And in urban areas, also the ownership rates are lower, but there is, the basic pattern is there. So you see that just taking ratios of the numbers on the previous page, the bottom segment has a shift in the ownership rate from 42 to 45 over this period. Okay? Whereas the top segment is basically constant at 56. Yeah, so there's so this thing that this guy is going in, becoming owners in this bottom segment that's present here. But it basically comes not because there is a lot of, say, new houses that people move into and so on, but rather it's basically because rental gets destroyed or becomes vacant. People don't like it anymore. Yeah, George. What's that?
The shift from 42 to 45%, is that on net or is it more over the boom?
I'm sorry. Yeah, good. Yes, this is over the boom, and it gets reversed over the bust. Yeah, that's right. So it basically gets exactly reversed over the bust. Sorry, I should. Yeah. Okay, so I got, very good. Yeah, so I got one more point I want to talk about, which is the role of financing. So we've talked about that there is this, so one of the big thing is this trading incentives of these simple movers that are important, okay? And so there's a range of models in which the thing is that you may not want to trade a lot if you're underwater or have little for down payment, etc. So it's interesting to think about, is there systematic differences across these segments in the financial situation? Okay, so this is what. So typically, when people talk about financing in a boom, it's about buyers, right? So to talk about what's the LTV ratio of guys that we observe buying. What we're going to do here instead, so we're going to show that, and what we're going to do then is what about guys who actually already have the house, because we want interested in the sell side. So the difference between these two. Okay, so this is the sort of typical thing looking at buyers, and it's interesting because we have this by type, and also because we have this evidence of the new boom. So here goes. So this is. Bottom segment, top segment, simple movers and investors. And this is just the share of mortgage borrowers. So 1 minus the share of cash buyers. And the point is, after the crisis, the market changed in a sense that the share of cash buyers went up a lot, or the share of mortgage borrowers went down a lot. Right? That was especially strong for investors and especially strong in the bottom segment. Otherwise, both for investors and the simple movers, if conditional on being one of these guys who borrows, of which the overall share fell, as we just saw, conditional on borrowing, then the LTV kind of similar.
So this is not like a median LTV. This is add up all the loans divided by all the households.
Aggregate, yeah.
And for the whole segment, that number is 0.9.
Yeah.
It's a big number.
Is it? Yeah. Yeah, I mean, so, yeah, there was, it was expensive. People want, yeah. But the thing is, it still is. Yeah, absolutely. Yeah. Yeah, so there, yeah. Okay, so this is a flow, right? Now, what about Stoke? So this comes from yeah.
Can I comment on this?
Sure.
There are lots of stories now where the housing boom and bust talk about changes in loan to value ratios. It's sort of critical. I'm not saying that's kind of the median story.
Yeah. So part of why
it's all in that segment. Somehow the top guys are never constrained anyway, so who cares? And it's always the bottom guys that are constrained. You're showing here, at least in the aggregate, there's no change in credit constraints.
Well,
for those that can get a mortgage.
Well, two things, right? So this is intensive margin. There is this. Okay, so this is aggregate loan to value for people who are borrowing. The share of people who are borrowing in the total, that dropped.
So okay, you're going back the slides. You're saying these are cash buyers?
Yeah, the others, yeah. This is 1 minus cash buyers.
Where are they getting the cash from?
Well,
if they're in the bottom segment. Maybe you're talking about this.
But it's bottom in terms of properties, not necessarily in terms of buyers. So the bottom is just the value of the house.
Yeah, it could be.
But I'm thinking of your assignment models where we put the low-income guys down there. But they still have enough cash to.
Yeah. So the story in the bust is that the overall debt that supported the house values fell, and the action is mostly at the extent of margin. Okay. So guys, yeah. So that's.
But how would the foreign investors show up here?
Yeah.
They come and buy, would they show? Because it's classified them as investors. Do you see them?
Well, we do not. So it's just based on trading behavior. Therefore, yeah. So there. I mean, if we were doing Palo Alto, there'd be a lot of Chinese, and the Chinese would show up as investors because typically they buy more than one house that they hold simultaneously for a while. Okay. Yeah. I got it. Okay. So that's so yes. So the one. So part of. So there's this cash guys that come in here that could partly be foreign investors. I don't know whether that's true in San Diego, but one can investigate. All right. So yeah. Okay. So I was going to show this. So this is saying in terms of the stock. So the guys who are guys who currently have a house, for them also the share of guys who are mortgage borrowers that basically went down. And so currently in this boom that we're seeing, that is much lower. And then there's one, in terms of the sell side behavior, one thing that was interesting to us is what about this underwater thing across segments? And so here what you have is that the LTV of the existing guys in the bottom segment, that was quite high for quite a long time. And then declined, whereas this was not true in the top segment. Okay, and so this suggests that partly the part of what's going on is that there's sort of this chill of people not trying to move because of these high LTVs, and then there was a recovery from these. So this is okay. So I'm basically out of time. So this was about who's selling, and so I hope we've given this overview of the volume by segment. And so we do see that there's big differences in the sell side across segments that relate to the large differences in price behavior across segments. And so the next step is to think about models where we jointly explain volume and prices, and then these relative differences are going to be of interest to sort out things. Thanks very much. Yeah.
You have people and you have segments. Do you see people trading segments? And if that changes over the cycle in any way, like people trading up to starter homes and
yeah, it's interesting. Yeah. Okay, so I can say that, so we did the following. We computed, so what that requires is not only seeing the spell, but seeing the move and the move before, so seeing moves. And we can say that over the course of the boom, the average increase in the price from sell to buy, that was large. And then in the bust, it was kind of zero. Yeah, so that's, in that sense, this starter home type thing. So a property ladder type feature that would be consistent with this. So we haven't looked more carefully whether it's across segments as well, but just in terms of the average gain, that's certainly true.